Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Donald Trump says he's made his pick for the next Fed chair, but refuses to name them. Markets await an announcement. Meanwhile, cryptocurrencies sell off while US and European futures are in the red, marking a cautious December start. Plus, American and Ukrainian negotiators say they held productive peace talks in Florida as US Special Envoy Steve Witkoff travels to Russia this week to meet Vladimir Putin.
Good morning, everybody. I'm a little surprised at what is going on out there, to be honest. I thought we'd have a fairly quiet start to December. That is exactly what we are not getting. And to be honest, picking just 3 assets this morning was a challenge. So let's talk about what we've got and what we actually don't have on this board as well. Look, the first thing to say is Nasdaq futures are down and down really sharply this morning. US futures broadly are down, European futures down a little less, but still down. So a negative start to the beginning of December. Nasdaq futures are down 0.8%. Is this the catalyst? What is happening with Bitcoin overnight could be the catalyst that is causing all of this. We're down by 5.4%. Are we about to take out 80? Are we going to have a look at 80? That is the next big line in the sand. We've also got UEDA speaking over in Japan, giving the biggest hint yet about a December rate hike. Are we about to see some rate hikes coming through from maybe Japan, maybe Australia next week coming through as well? Japanese yields are responding to that. What I haven't put on the list this morning is European futures. Big omission, and also Brent, which is up quite sharply as well. Metals are on the move. There is a busy start to December underway, and the countdown to the opening trade starts right now.
Are you Fed chair? Are you any closer on that right now?
I know who I'm going to pick. Yeah.
Oh, tell us. Kevin Hassett.
I'm not telling you.
How good is he at keeping secrets? I think we're about to find out, and it's really going to matter for financial markets. Trump says he's made the pick. Who's it going to be? Hassett. The money is on Hassett, right? Kevin Hassett looks like he's going to be the next Fed chair. The question is, if he announces it early, do we end up with 2 Fed chairs? Do we end up with Hassett and Powell? And which one do you listen to?
Yes, and does that change? Does the thinking around who you change depend on how the Senate hearings are going, or is that just a sort of a tick box exercise? But we have heard from President Trump that he will be announcing it. When will it come? We don't know. But Scott Bessent quite recently has been saying, last week he was saying this could come before Christmas. They want to announce it before Christmas, so that narrows down the window just a little bit. It was interesting that Kevin Hassett himself was being interviewed about this yesterday. He wasn't giving any ground on whether it was him or not, but he did say that when the rumour dropped into the market about him, that it went down quite well, and he flagged that rates went below 4%. The 10-year, this is, yield, went below 4%, and he thinks that that's an indication of the lower mortgage and vehicle repayments that he would bring.
He seems very aligned with Trump, and the expectation, therefore, that he's going to try and push rates sharply lower. So do you listen to that? When do you think he could be Fed chair? Does Powell go early? Could Powell go early if he feels that his case is being undermined because of the fact that Hassett has been announced early and is making a lot of policy speeches? I don't know, but the market's got a challenging period coming up.
It has. Well, do you still come round to of course, the Fed chair, it matters. Of course it matters. The market will move on this. But do you also, in the same breath, have to mention that there is a committee? And
absolutely.
It's not just one person, and so maybe there is room for both of them to exist, one formally in role and one to be appointed.
I think, yes, but I think you don't normally have quite such big policy divergences, and the incoming normally is reasonably quiet
without the politics.
Precisely, and so you've got the politics around all of this. But also, kind of, how does the rest of the FOMC stack up? How divided will it be? Like, inflation looks like it could be still a challenge next year.
Yes.
How steep does the curve get on all of this? So I think it's going to be really difficult for the market to navigate.
It is, and let's think about where the market is right now, because you were making the point that it's actually a busier start to December than maybe we're expecting.
What's going on?
Yeah, what is happening? I mean, US futures pointing down, which is interesting, because if this was all about appointing a dovish Fed chair, then you might have thought maybe there's room to rally on that, but maybe we've rallied already on that expectation. So that's part of the conversation. But really, crypto is on my mind, because Bitcoin down more than 5% earlier on, Ether down more than 6%. So there's some decent moves to the downside and not a lot of dip buying, is the point being made by the Markets Live blog.
Can you put your finger on why crypto is down?
No, don't ask me hard questions, Guy. It's Monday and it's 7:04.
I have no idea.
No.
I genuinely have no idea. I looked at it last night and I looked at it this morning, and I can't figure out why we've got from A to B. And it is a genuine mystery to me. I'm now wondering what effect it's going to have. Can we assume that Nasdaq futures are down because of crypto? I don't know again. And What effect are other assets going to have? Like oil is up this morning.
Yes.
Is that an inflationary concern?
Exactly.
Metals are up.
When I was asking myself what is driving this crypto risk-off move, I was thinking, well, is it just broadly risk-off and stocks are weaker, as you say? But metals are not, and commodities not. I mean, there are supply stories there, so it's a bit more complicated. And Chinese stocks are up, even though we got disappointing PMI data. That's an expectation. We get stimulus, of course, the housing market.
News.
Exactly. So we're back to that narrative. And then you've got the Japanese in the mix. UEDA speaking, as you mentioned earlier, that's moving the yen around quite substantially, up by 0.4% this morning. And Japanese stocks are really under pressure. So that's certainly one of the elements of the risk-off.
No idea what's going on. Genuinely no idea. I was expecting a quiet Monday morning. Not getting that. It's fun. Let's talk about what else we're watching this morning. We're keeping a firm eye on what is happening with Ukraine. So over the weekend, what we learnt was that talks between the United States and the Ukrainian officials are productive. Are they productive enough now to see a deal coming through? Because Witkoff is now going to Russia, and you do wonder kind of what, therefore, influence the Russians will have. Apparently, the Russian view is well understood, so all the discussions between the US and the Ukrainians theoretically should include Russian thinking. I don't know. But are we getting any closer? Because we've got to this point before, and it's felt like the Russians have gone, no, that is a step too far for us. We're not going to do that. But all of this comes... there's so much going on here, and you do wonder where Ukraine is going to end up in this sort of deal. How much sovereignty will it have?
Yes.
What ability will it have to defend itself? By extension, what ability will Europe have to defend itself? What happens next for European security, I think, is massive here in terms of our understanding of it. We're going to be talking this week to a whole bunch of defence companies. Where are we in this process of rearming Europe?
Yes.
Is Europe going to be... if you get a deal now, the race is now on between rebuilding Russian forces and rebuilding European forces. And who gets there first, I think, is huge for European security.
And the nature of the deal and the extent to which it is seen as being long-lasting and durable will probably have a huge impact on the thought processes around restocking defence and rethinking defence strategy around Europe. And as you say, we're going to talk a lot about this. President Zelensky is in Paris today. We have EU defence ministers meeting in Brussels today. And then we see Witkoff on his way today, later today, we understand, to Moscow. So there's a lot at the beginning of this week around this defence story. We're going to be talking about this a little bit later on. Europe is really trying to assert itself around this table, trying to keep a seat at this table. But we can see where that conversation goes.
Is Europe going to end up being a price taker in terms of its ability to influence this process? And it increasingly looks like it. And therefore, European sovereignty, the ability of Europe to defend itself, the future of NATO, all appear to be up in the air at the moment. A lot going on. Let's talk about some of the guests. We've great guests we've got coming up to be able to talk about this. Henry Allen, Deutsche Bank Research macro strategist, is going to be joining us. Vivek Pandya is going to be joining us from Adobe. Did you go shopping this weekend? I know certain people that did. I'm not going to name names. My wife, fairly near the top of the list. Dan Kemp, Morningstar Chief Research and Investment Officer, is going to be joining us. And Samir Hussain joining us from Alpha Value, Defence Equity Analyst, joining us a little bit later to talk about some of the things we've just been referencing, which takes us on to the week ahead. Yeah, absolutely. Let's think about the things that are on our agenda this week. Today, we have an EU Defence Ministers meeting in Brussels. It is also Cyber Monday, so two fairly divergent news agenda items. Bank of England will be publishing the results of its bank capital stress tests. That's tomorrow. We also get Euro area November CPI, which I'm a bit focused on. Wednesday, Macron is in China for the fourth state visit. NATO foreign ministers are meeting. And we also get a load of data towards the end of the week from the US. Of course, jobless claims, it being Thursday. But then Friday, we also get the delayed September US payroll and PCE inflation data. So that's going to be really important. How much of it... Will the Fed listen to this data? What is the Fed working off? We're now 88% chance probability priced for a December rate cut. Why, is my question. What data are we looking at? The labour market data recently has been all right. We're going to look this week at ADP. We're going to look at claims. The claims data recently has been fairly stable. Is the inflation data too backward-looking for the market to get focused on, for the Fed to get... I don't know. Yeah. It still feels like a coin toss, but the market has pushed us towards 88%. But November, huge volatility in Fed expectations. Yeah, there has been a lot of volatility, hasn't there? We'll see whether that is done or whether we have a volatile December, thinking about that in the run-up to that meeting in the week ahead. Let me mention just briefly what we're expecting around Eurozone CPI, because that's tomorrow. I mean, nothing to see here has been the story for about 4 or 5 months on the Eurozone, hasn't it? But we've got that German inflation print just last week that was a bit higher than anticipated. Still, Naglis is not giving many clues as to where he thinks inflation is heading. And the expectation is still the ECB is going to sit tight. Yeah. But I'm also reading quite a lot of research notes suggesting that actually you need the economic data to pick up now. Otherwise, there is the risk that actually the ECB needs to go again. And maybe not on the inflation front, which looks reasonably stable, but some of the growth numbers are a concern. What else do you need to know this Monday morning? There's a lot going on. Australia has become the world's first democracy to decide to curb youth access to popular media platforms such as TikTok and Instagram. The platforms will be required by law to block under 16s from holding accounts from December the 10th. Companies that don't comply could face fines of up to 32 million. The measures are spurring an increase in the number of governments seeking to hold social media firms to account for toxic content and cyberbullying. Switzerland has voted to reject a 50% inheritance tax on super-rich residents after wealthy entrepreneurs threatened to leave the country. Government data shows that more than 78.3% of the electorate opposed the plan. The left-wing Young Socialist group had launched the proposal as a way of raising funds to fight climate change, but the plan ran into staunch opposition from the government and all parties aside from the left. And airlines across the world have been racing to keep their fleets operating after being forced to carry out an urgent software update on one of Airbus's most widely flown aircraft. The company revealed the fault on the A320, which apparently the fault risked corrupting computer data that helps maintain flight controls. Basically, this happened after a JetBlue flight, which had an issue. Airbus went back and looked at why, and they found that potentially solar radiation could be affecting some of the software relating to the flight stability software. And as a result of which, I basically got to quite quickly come out and said, we need to update this software. Yeah. Now, for most aircraft in the fleet, that is an aircraft example type, this is just a software update. And it looks like most airlines have done this fairly quickly and effectively. Some of the older aircraft within the fleet are going to need a hardware update. But here's the thing. I still haven't read anywhere about what is happening here. The solar radiation is affecting the software. Why? What is going on? So I haven't actually seen any details as to why that is happening.
Because it feels like without knowing that, you're not really sure whether this is the end of a story or the start of something else. Yep. When cosmic radiation is doing this, what else is cosmic radiation doing to the data on board? Yep. Just worth flagging that we got a red headline this morning saying that Airbus says the vast majority of around 6,000 A320 jets have now been modified. Only around 100 still left to do, which out of 6,000 isn't bad. Because even the ones that just needed a software update, they still have to be, I think, mostly on the ground to do that, don't they? And they have to maybe takes a couple of hours. So it's been a big logistical challenge.
I spent the weekend looking at flight data, and it does seem as if there were very few delays. Very few airlines had delays this weekend as a result of what happens here. So they seem to have been able to manage it quite quickly. But it does in some ways show the risk that the world of we talk about being one of Airbus's most popular aircraft. It is the most popular aircraft. They produce huge volumes of these things. This is the narrow-body aircraft. There are so many of these things out there flying. This is basically, if you get on an airplane, the chances are you're getting on one of these or a 737. And it shows you how big a risk there is to global fleets if there is a problem with this aircraft type.
Yes, and they like to have fewer aircraft types to keep their business models simple, don't they? But the downside of that is if there's a problem. Yeah, if there's a problem with one of them. Right, 7:13 here in London. Coming up on the programme, Black Friday sales are higher, giving a glimpse of US consumer resilience. We will look ahead to Cyber Monday. Yes, that's what today is. If you didn't do any shopping on Friday, today also has a name for it. Plus, we'll keep an eye on defence stocks. We've mentioned already peace talks in Ukraine have been advancing, it seems, or at least they haven't fallen apart, while Germany boosts its arms spending. We'll talk about all that is on the defence agenda this week. Up next, markets kick off December on a cautious footing as they look ahead to Donald Trump's Fed pick. We'll get into that conversation next. If you want to be involved in these conversations around this desk, IB plus BBTV Go. That's the function on the Bloomberg terminal. This is Bloomberg. Welcome back, everybody. This is the opening trade, 17 minutes past 7 here in Europe. And European futures are weaker, Guy. And there are plenty of contenders as to why the futures picture looks weaker. Some of them coming from Japan, some of them coming from crypto. We're also thinking about what's going on with the Fed, which a dovish Fed chair wouldn't seem to prompt a sell-off in stocks.
Answers on a postcard as to why we're seeing risk off this morning, because We're in the game this morning of picking narratives and trying to pin them onto market moves. I have genuinely no idea. It could be the Fed, it could be something else, it could be UEDA. Honestly, who knows? Anyway, apparently Donald Trump has made his pick for Fed chair. National Economic Council Director Kevin Hassett is widely seen as being the front runner. Here's his take, talking about the president's decision, speaking to CBS over the weekend.
We had a great Treasury auction, interest rates went down. And so I think that the American people could expect President Trump to pick somebody who's going to help them, have cheaper car loans and easier access to mortgages at lower rates. And that's what we saw in the market response.
Pick me, pick me, pick me. I'm going to be the next Fed chair. Are we going to have two Fed chairs? Is that going to be a problem? Are we going to have Powell? If Trump announces before Powell goes, or announces before Christmas, who do I listen to? There's so many questions surrounding this story. And will Hassett really be able to cut rates aggressively if he were Fed chair? Would the FOMC be a problem for that? Let's try and answer some of these questions and try and get an understanding of why we think assets are down this morning. Henry Allen, macro strategist at Deutsche Bank Research, joining us around the table. Good morning.
Morning, Guy.
We're about to have two Fed chairs, and if so, which one do I listen to?
I don't think we're about to have two Fed chairs, at least in terms of who to listen to. I think once the appointment is made for the new Fed chair, I think attention is going to turn on to whoever that might be. I mean,
so I can ignore Powell at that point.
It's not completely ignoring him, but at the end of the day, Powell's 4-year term as chair is up in May. Even if he stays on as a governor, because he has that longer 14-year term.
I think he stays till May.
Well, his term as chair goes until May.
Yeah.
So,
but could he go before then?
He could theoretically, but I don't see the incentive for him to do so, given he's made quite clear that he's not going to resign early. He's going to fulfill his mandate as appointed by the Senate. There's no incentive for him to go before May. So I think he'll serve out his 4-year term. And certainly the narrative has all been that Trump's appointment is the person who succeeds him after May. So it's not until the June meeting that the new Fed chair would be in charge.
But you are expecting this to be a Fed under whoever it is under that keeps cutting interest rates. What's the extent of that cutting then, Henry, that you're looking ahead to?
I think it's going to be pretty limited. So, I mean, it looks like December is a lock on, but actually our house view at DB is only for one cut next year. And I think the problem that the Fed face right now, well, there's more than one problem, one of which is that inflation is 4 years plus on, still above target. Not as much as it was, but still lingering above target. That's constraining their room for manoeuvre. The other thing that I think is not widely appreciated enough is even if the Fed stopped cutting right now, they have now delivered 150 bips of cuts since September 2024, so only 15 months ago. That is the fastest pace of cuts outside a recession since the 1980s. This is a very unusual framework that we're operating in, whereby they're going quite rapidly by non-recessionary circumstances. So given monetary policy operates with a lag, that lag is going to be felt into 2026. Inflation is already running above target due to tariff pressures that are still filtering through. And we've got the fiscal impulse and the big, beautiful bill that's really going to hit Q1 next year.
Yeah.
I think they're going to want to be cautious, not least because actually, even if the new Fed chair is really dovish, they are still constrained by the board around them.
That sounds like some overheating concerns then for the US. So to what extent? And I mean, it might mean the Fed doesn't cut so much, but what else does it mean?
So I think the risk is that you kind of have inflation lingering above target. But actually, I think the more critical implication in terms of what it means is the tariffs. So already we have seen Trump, particularly in response to affordability concerns and stuff, say, and indeed in response to the election results recently where the Democrats did quite well, he has already dialed back a few tariffs on beef, on coffee, on foodstuffs, which are quite obvious in the consumer basket. I think that, if we do see signs of overheating and persistent inflationary pressures, actually the pressures for other things like tariff relief...
Going into the midterms, clearly inflation is a big issue. And you saw that in the recent elections that we had in the United States. You're going to have a Fed cutting rates, potentially boosting inflation into a midterm election in which inflation could be a problem for the Republican Party. That sounds like a weird... That he wants the Fed to cut, but he's got an inflation problem.
Might be pushing up...
Which one of those two is more important?
So it might be pushing up prices, might also be pushing up... there might be wealth effects from pushing up stocks, I suppose, and... I mean, it sounds increasingly K-shaped, like some parts of the economy will be suffering from higher inflation pressures, others will be cushioned from that by higher asset prices. Is that what we get in this overheating scenario?
I suspect to some extent, but I think the pressure will remain to get inflation down in the sense that it has been striking across the world over the last 2 years.
If you want to get inflation down, cutting rates is not the first thing you would do, though. So what is the message from Trump to Hassett? Is it cut rates aggressively, or is it be cautious because I want inflation to come down?
So I agree when you say that there's a dichotomy between those two things, but one thing that we've seen across the world over the last 2 years is that governments, incumbent governments at least, of all political stripes, have faced these cost of living, inflation, affordability, call it what you will, we have seen incumbent governments lose power and gain unpopularity at very rapid rates. And I think a key part of that is that you've got this lingering inflation problem, particularly in the more obvious parts of the consumer basket, like food. That's showing up already.
So what does Trump tell Hassett? Does he tell him to cut rates aggressively? Because Hassett thinks the message at the moment, judging by what I've heard, is cut rates aggressively. But is that going to end up being the message from the White House if there is the risk that they end up losing big time in the midterms because inflation is high?
Well, I think it's coming through in the sense that actually interest costs are a factor in terms of people's perception of inflation. So hence Hassett mentioned the car loan point and mortgage costs. And so there'll be pressure on that front. So I definitely think that the pressure to keep cutting rates will persist. The problem is then, do we then see rollbacks on the tariffs or the fiscal stuff? I don't think it's monetary policy.
But a mortgage rate's going to come down if the curve steepens, because the US is on 30 years.
Yes. So a lot of focus on the
front end comes down, long end goes up.
The White House could change its mind about what it thinks as well. There's a curveball for 2026. So what does all this mean for investment strategy then, Henry? If we're thinking about inflation being a bit sticky, rates coming down but not by much, an inflation concern, messing with the politics in the United States, what does that mean then for investment strategy?
So I think, despite all that, I think actually the fundamental backdrop does remain bullish. I mean, one, of course, is we haven't talked about yet, but the AI story is still, leading to big productivity upside potential. I think even on the inflation and the risk of Fed hawkishness, so long as the Fed don't pivot to outright hiking rates as they did in 2022, I think the market is already pricing in some degree of cautiousness in that they know that whoever becomes Fed chair isn't going to suddenly lead to hugely aggressive cuts. And actually, when there were rumours that Powell might be fired, for instance, one in July, the New York Times report, you saw a big market turmoil that meant the administration rode back. So I don't think the administration are going to go too crazy on it.
And you mentioned AI. I mean, when do we get the productivity gains? I was looking at the UK context, some of the detail coming out of the OBR, and it's not actually for a few years that they're expecting that there's a sort of big pick-up in productivity as a result of AI. From a global perspective or a US perspective or wherever it's easy to look at, I mean, how long do we have to wait until this is really visible to us in data, do we think, Henry?
Yeah, that's a really good question. I think the more obvious AI impact is going to be things like data centre investments kicking through. If you look at the quantity of GDP growth that's being supported by AI, that's quite strong. You'll still get the wealth effect. You know, the S&P for 3 years in a row now has been up at least 15%, so that's feeding through into wealth effects.
Effect, yes.
Totally. Before we then get the productivity effect, I think the productivity effects are more like a 3+ year time horizon. I'm thinking about it in the same way a bit like the early internet, in that, yes, we know it's going to be transformative, but it will take a while before it filters through into all our lives.
Because the wealth effect and all the AI stock gains, they're worth much less if the productivity gains don't come through, aren't they? So,
totally.
you know, there's the risk, I guess.
If the Fed only cuts twice, does the dollar go up?
Does the dollar go up if the Fed cuts twice? Other things equal, I'd say yes, on the grounds that at the moment the market is pricing in 3 to 4 cuts.
Yeah.
So, yes, other things equal, then yes. I guess it also depends on...
Because we're not set up for a stronger dollar next year.
No, I guess it depends on the reason the Fed doesn't cut, because I guess there's the good reason the Fed doesn't cut, i.e. growth is stronger and it's priced on the upside, and there's the bad reason the Fed doesn't cut, which is inflation is sticky. And actually, if we look at recent years, the framework, depending on why they don't cut, is hugely dependent for investments and markets. So if it's 2022 and the reason is inflation is really sticky, very, very bad. Multi-asset sell-offs like 2018, 2015, 16, 22 often coincided with Fed rate hikes. If, however, it's a bit like we saw in 23 and 24, where the Fed were much more cautious on the way down than had been priced in, but the reason was because growth is consistently pricing on the upside, then actually the gains to risk assets, I think, can continue.
OK, Henry, thank you so much. Thanks for joining us. Henry Allen, macro strategist at Deutsche Bank Research. Great conversation to get the programme started with this morning. 7:26 here in London, coming up on the programme. We'll put our focus on retail. Black Friday sales rise, underscoring the resilience, perhaps, of the US consumer. We will look ahead to Cyber Monday. We'll be joined by Vivek Pandya from Adobe. Next, this is Bloomberg.
Morning, how you doing? We've started December, and it's not going well, to be honest. Let's take a quick look at futures and figure out what is happening there. We are down, certainly when it comes to Nasdaq futures, we're down by 0.8% this morning. It is technology that feels like it's taking the hit. Why, I have no idea. It could be what is happening with Bitcoin. It could be that. It could be what's happening in Japan. It could be the fact that we've got a new Fed check. I don't know the honest answer to why futures are lower this morning, but they are lower. And it's interesting, actually, the composition. Look at the FTSE, down by less than most of the other European markets because metals are higher. So is that going to feed through? Oil's higher. So is that going to feed through? Yeah,
oil higher, metals, as you say, copper, certainly one of the metals that we'll talk about later on in the programme. So that'll be something, a divergence to watch perhaps with the London market. Let's have a look at bond markets, because if investors are getting out of stocks, are they getting into bonds? Well, no, that doesn't seem to be what is happening here. So we're not seeing a large amount of money going into fixed income across the European space. We certainly have those yields ticking up a little. 3 points this morning is all that we're talking about here. But that's not what is going on.
Big move in Japanese bonds this morning.
Yes,
on
absolutely.
The back of the UEDA
and
comments.
Japan, perhaps we've under-mentioned today, but big move in the yen and big move in Japanese stocks on the retreat as a result of UEDA talking about those rate hikes. Let us talk about what's going on in the retail space then, as it's been a busy weekend. Sales on Black Friday rose from a year earlier. That's according to a key retail data provider, Adobe. It is a sign that consumers are continuing to spend despite persistent economic concerns. Adobe forecasts a record $253 billion will be spent online this holiday season, up over 5% year on year. We can talk now to Vivek Pandya, lead analyst from Adobe. Vivek, nice to have you with us. Let's start our analysis with a sort of global lens, perhaps a US lens here. I think you're with us from the United States right now. So let's focus there first. I mean, we talk a lot about, and the president seems to be increasingly focused on the cost of consumption in the US, cost of living, as we might call it here in the UK. And yet we've got consumers going out and spending a lot. So what is this telling us about the state of the consumer in the United States?
Yeah, and I think, as you mentioned, we look a lot at the online retail data at Adobe, and we are seeing some pretty resilient growth and stable demand around retail goods, especially during this period of the sort of Black Friday, Thanksgiving we just had, and we're going to be going to Cyber Monday. When we see something like over 9% growth for Black Friday, driving over, the sort of getting into that $12 billion range, I think it shows that consumers are still leaning pretty heavily to try to find that value in the online space, and that's what's accounting for the momentum we're seeing this week.
And is it a story of two different consumers in the States, or maybe even three, where the top end of the consumption basket being supported by asset price inflation, the lower end struggling more with that cost of living story? How would you characterize the US consumer right now, Vivek?
Yeah, well, the online consumer has typically been a more affluent consumer, but then when we had things like the pandemic and things like that, we saw, more people shopping online, very comfortable buying different things online, and then a lot of budget options for consumers as well. So that brought in consumers across the income spectrum. So we see the popularity across the board, but you see these moments, the events really driving these eventized sales to the point where you have different consumers really looking to see, okay, do I purchase now and avoid trying to, manage and determine how price fluctuations can impact purchasing in the future, or do I try to get these deals now? So that's why we do see that sort of momentum across many different, generational cohorts, but then income cohorts, and that's what's allowing us to see this sort of level of spending at this point in the season.
Vivek, if I back out inflation, which let's call it 3% in the United States and maybe a little bit more here in the UK, if I back out inflation, how good do the numbers look? Is this just inflation? Am I just having to spend more this time round and get the same? Or am I actually getting more for my money? Talk to me about this uplift, because everybody's saying it's going really well. But I back out inflation and the numbers don't look quite so good.
Well, we look at online retail inflation we've looked at it for 5 to 7 years, really, especially for the US, because it's been an online space and a sector that's been really characterized by a lot of deflation, because you had many retailers emerge onto the online scene. That approach gave consumers a lot of options, and that competition vying for the US consumer's dollar allowed them to get a lot of favorable pricing. And even though different categories are responding differently to price fluctuations over the past couple of years, we still do see across categories like electronics, apparel, especially computers, we still see online providing a more favorable environment for prices for that consumer. So many of the prices are kind of at the level that consumers have been expecting in terms of online prices. And then when we think about something like grocery, that looks a little bit more like offline. So you're not getting as much value in terms of grocery prices increasing.
Okay.
So in the aggregate, though, it's been pretty effective for the consumer to lean on the online space.
Any sign that people are using AI to find deals?
Absolutely. So we've been looking very closely at how traffic has been moving from these generative AI platforms to retail sites. And that's up over 800% in the US. It's up over 300% in the UK. So you're having consumers more comfortable leaning on the platforms for different use cases, and they're asking questions around, ideas, Christmas lists and things like that. And then it quickly evolves to, where can I get the best price for this good, or cheaper versions of this good? And that's why we're seeing this influx of traffic to retail sites. And once they make it to the retail sites, we're finding that they're buying and converting more effectively than non-AI source traffic. So some pretty massive implications there for the retail space.
It seems, Vivek, that complaints about a lack of deals on Black Friday and Cyber Monday are almost as traditional as Black Friday and Cyber Monday now. Certainly, lots of reports feature consumers complaining about a lack of big deals. I mean, what does the evidence show about how much things are really reduced on those days?
Well, when we look across the trajectory of discounts, we see discounts being introduced in as early as late September here in the US, and then promoted as Black Friday deals all through October. But really, the discounts really accelerate once we get into Thanksgiving week and Black Friday week. So they usually stay in the 10 to 15% range, and then they start to escalate, and we see discounts go as deep as 18 to 28, 18 to 30%. So you're seeing consumers being able to see those, wait around for some of those really aggressive discounts, and then we start to see the revenue really scale as they take advantage of them.
Vivek, we're going to leave it there. Thank you very much indeed. Vivek Pandya, lead analyst, joining us from Adobe, talking about what we've seen over the weekend, Black Friday into the weekend. Cyber Monday, is that still a thing? It sounds like everybody is online. It's Cyber Monday. Do you actually, who went to a store this weekend? I'd be interested to find out. Seems to be a lot of shopping going on, but not a lot of store visiting. Anyway, up next, we're going to talk about what is happening in the aviation space. A lot of people trying to get away over the weekend for Thanksgiving. Was it affected by what has been happening with this aircraft? The Airbus A320 family having to have a significant software update. We'll talk about that and all the other stocks that are on the move this Monday morning. That's next. This is Bloomberg.
Welcome back. This is the opening trade, 7:41 this Monday morning. And Guy, European equity futures looking negative. US futures, with the exception of London, which looks kind of flat to negative.
Yep.
US futures also looking negative. And one of our questions this morning is how much does this have to do with some slight at-the-margin hawkishness coming from Governor UEDA over in Japan? It's certainly moving Japanese assets.
Yeah, you're getting quite a big move in Japanese assets.
Yeah.
So you can't... The market's been anticipating the fact that we are going to get a hike at some point. The fact that he now appears to be giving us language that indicates that it's going to be at the next meeting, we're going to have this in December, appears to be what is moving things. So maybe that's at the margin, and everything's kind of always about the arbitrage. It is, maybe that's a little earlier than anticipated, appears to be maybe the reason for that. I think it's the bears. UEDA this morning was mentioning actually a problem the Japanese are having with bears. In fact, when you get a central banker talking about bears...
And these are actual bears.
These are actual bears.
This has nothing to do with yen bears or stock bears.
No. Yeah, these are actual real bears affecting the economic story in Japan. So that... if you were to sequence kind of why things are moving this morning, maybe you'd put the Bank of Japan up at the top of the list. But there's lots of reasons this morning why assets are on the move, which is a surprise. But anyway, let's talk about what is happening over in Japan. The yen strengthening this morning. Anna's mentioning what's happening in the bond market as well. Governor UEDA giving his clearest hint yet that we are going to see potentially a rate hike. The 2-year has been on the move. We've got a highest level for the Japanese 2-year since 2008. Bloomberg Economy and Government editor Paul Jackson joining us now from Tokyo. Paul, he appears to be nailing down the idea that it is going to be December, and the language appears pretty clear. He's got some history with doing this, UEDA, and clearly signalling when we're going to see a hike. Why are we getting such a big reaction to it if the market had at some point anticipated that a hike is coming?
Well, I think there'd been some debate about whether it's going to come in December or January. So clarity on that obviously is going to get a market move. And although we've seen a lot of Bank of Japan board members weighing in on the need for rate hikes in the near future, I think we're still waiting for some clearer signalling to come. Now, this Nagoya speech from UEDA and his later response to questions has been seen for a long time as a key point for, is he going to give a signal for December? And in terms of the language he used, he referred to making an appropriate decision, not on policy, but an appropriate decision on a rate hike. And that is the key language he used back in January before the Bank of Japan raised interest rates. He also said that any raising of borrowing costs would be like pulling the foot a little off the accelerator, not putting it on the brakes. In other words, hey, nothing to worry about. So I think all of that gave a lot more clarity to people in markets and BOJ watchers. And if you look at overnight swap indexes, the index of overnight swaps, you'll see that, the possibility of a December rate hike was like in the 50s at the end of Friday. And now last time I looked, it was about 82% now looking at a December rate hike.
So does that language suggest then, Paul, that he's setting us up for a dovish hike in December if he's talking about, the foot coming off the accelerator rather than onto the brake?
Yeah, I think the whole kind of framing of this is, we have an economy that's contracted in the last quarter, right? So they can't in any way be suggesting that we're tightening the screw on an overheating economy. No. It's you've got inflation at 3%. It must be dealt with. Another key element in all of this is the weakness in the yen. Now, look, if you don't move in December, that's quite a long wait till January when you've got the yen in that 155 to 160 zone against the dollar. So I think there's quite a few things pointing towards December. But will he have some dovish language at the time? Yes. And is it 100% assured? No.
Paul, I was wondering about this morning. The fact that we didn't get intervention, should that have been the first clue a few days back? I think it was this time last week. We're talking about the fact that Japanese markets were closed. You could potentially see, therefore, the Ministry of Finance coming in and intervening in the market. Was that maybe the first clue that actually a rate hike was coming, that the language was going to be changing? They didn't need to do that intervention because of the fact that it looked like December was going to deliver a hike. We didn't know that, but they would have known that.
I think the language was a bit vaguer at that point. So the finance minister came in suddenly very strong, suggesting that they may move on intervention. And I think at that point, you look at the dynamics of where the currency market was heading, it looked like, heading towards 160 might be on the cards. So I think some strong language was overdue from the finance minister. She gave it then. And I think the government was prepared to intervene if needed. But obviously, ideal scenario is you don't do that and you let the fear factor, the trajectory of higher interest rates do the work for you.
Paul, thank you so much. Thanks for your analysis. Bloomberg Japan economy and government editor Paul Jackson with the latest from Tokyo. Joining us now with a wider look at what's happening on markets, Skylar Montgomery-Koning from the Bloomberg Markets Live team. Skylar, very nice to have you with us this morning. So let us dive into this question that we've been wrestling with for about 47 minutes now, which is why stocks are quite as risk-off as they are, because, European futures are a little weaker, but NASDAQ futures down 0.8%. Maybe there's a Bitcoin read across. There's the Japan story we've just been discussing in depth. I mean, what's your take on why things have started on the back foot in December?
Yeah, I think it's really just a symptom of investor cautiousness, all of it. And so you get pieces here and there that are maybe negative news, but maybe the clearest sign of that investor cautiousness is the amount of money you're seeing in cash. So if you think about the amount of money in money market funds, that's actually reached an all-time high on some measures. And so that tells me that investors are very cautious. And it does mean that money could move into risk, but there are a few reasons in the near term it's probably unlikely. The biggest reason is just we have so much data, and so you're likely to get pinged around on that data. We're also very dovishly priced for the December meeting from the Fed. It's pretty much fully priced for a cut, and you're going to get some forward guidance from that meeting that might skew a little bit more hawkish. I think the other point is that, you know, the cash yield is pretty good, so why not just park there until you get further into December or into the new year. And then finally, you haven't seen that flow become stretched yet. So people aren't rushing into money market funds, and so there's not a reason for that to kind of have a reversal. I think it does mean that once you get past this data and you have a clear view on the economy, there is cash that can go into risk, but we're just not quite there yet.
Let's talk about Santa Claus. Is he going to show up? In order for him to show up and deliver a rally, do we need to see positive news, or is it just the absence of negative news, i.e. stability, that gets Santa to show up at my doorstep?
I think in this year in particular, you need some positive news to get Santa to show up on your doorstep. I mean, I would say that the Santa rally obviously is grounded in fact in terms of you do tend to see a rally in the last month of the year.
But it tends to be quiet. So low vol.
Exactly. You need to have some kind of fundamental reason for why that occurs, and it's because, you know, low vol, you tend to see you just go with whatever equities do, which is generally most of the time they go up, but because you have so much data now, you're not going to get that low volatility environment. So I think you need to be more cautious, and you need to see those positive signs, and I'm just not sure you're going to get them because the number one driver that we've seen of equity markets recently has been your monetary policy view. And we're very dovishly priced there. And so I don't know how you get a terminal significantly lower than 3% without having economic data damaging that would also outdamage equities.
Yeah. Skylar, I'm in danger of having focused too much on the Mag 7 in 2025 and not enough on the wider S&P or wider global stocks. And certainly over the weekend of getting a reminder of that with lots of our stories talking about how some of the European stocks, in particularly Eastern Europe, some of those stock markets have done pretty well. I mean, what's your thinking on how European stocks have actually done pretty well when you look at the top 20 performing indexes over 2025? There's quite a lot of European names in there, and whether that's repeatable, whether that can continue.
I'm a little bit more pessimistic there. I think generally equities trade together. So if U.S. equities are up, then European equities are likely to be up as well. But I think there was a lot of optimism put into fiscal that was announced out of Germany in March. And there was this expectation that it would spread beyond Germany into other countries. And we haven't really gotten that. And the fiscal that we have gotten out of Germany, a lot of it's not directed in the same way to stuff that has a high multiplier as we were expecting. And so as I think we head into next year, that growth is more likely to disappoint in Europe as you don't get the big fiscal spend that's been priced in already.
So the clock's gone to zero, but I've got time to ask another question. Don't ask me how that works. The dollar. What happens next with the dollar? You talk about the fact that we are quite dovishly priced on the Fed, and if we don't deliver upon that, do we get a stronger dollar? Because the dollar's been really important this year. The S&P in euro terms is up by 3.83%. The German market's up by nearly 20%. The IBEX is up by 41%. Europe has massively outperformed because of the currency this year. So what happens next year could be really important. If the Fed doesn't deliver, does the dollar go up?
Yeah, I mean, absolutely. When I'm thinking about currencies, the number one drivers are growth and rate differentials. From a growth perspective, I think it looks quite good in the U.S. right now. Yes, You've had the slowing of the labor market, but you're getting fiscal stimulus, you're getting monetary stimulus. You could get more next year, and that means you have more of a hawkish risk within your yield view. And so that means rest of the yields are up, especially as I talked about with that terminal at 3%, unlikely to go lower. Yep. And then I think, too, you just haven't seen this mass exodus from the U.S. market, right? AI means that you're still getting growth in the U.S. It also means that U.S. equities are relatively attractive. The yield on a U.S. 10-year or even bills at the front end is very attractive. And so that means people are still parking money in the U.S. And I think the story that we had at the beginning of the year where we had the end of U.S. exceptionalism and people going out of the dollar and the U.S. generally, you just haven't seen it in the flow data aside from kind of 1 week in April.
OK, 1 week in April. We remember it well. Skylar, thank you very much indeed. Skylar Montgomery-Koenig joining us from the MLive team. Let's find out which stocks we're watching as we start. There's a big picture of an Airbus aircraft, so I'm assuming that Chloe Melle's starting with Airbus.
Indeed. Good morning, guys. So let's keep an eye on Airbus today after quite a big disruption over the weekend. So a software update on the A320 required an urgent fix, and that really led airlines scrambling to get that sorted during a very busy Thanksgiving weekend. So we'll see what that does for this today. This is something that was actually sorted quite quickly, a limited disruption. But the problem is now experts are saying that this means that potentially that software update was done without the appropriate safeguards ADRs, the appropriate guidelines, and therefore that could weigh on that share price today. Moving on, but staying within the airline sector, and JP Morgan put out a note this morning saying that this is a sector that will continue to see challenges in 2026, but there are winners and losers within that. So IAG, for example, is a top pick. Air France was raised to an overweight rating, and that's because the dynamics in long haul are actually quite favorable. But then EasyJet, on the flip side, was downgraded to a sell rating, and that is because of weaker pricing and much higher costs. And so we'll see how that goes today, and whether or not we keep that same picture with EasyJet underperforming in that way. And finally, we are also keeping an eye on Montepaschi after documents are showing that the CEO of Montepaschi allegedly coordinated with two big Italian investors to seize control of Mediobanca. So we'll see how the market reacts to that this morning. BI analysts have said that this is something that could potentially present a new challenge to the integration of those two banks, which are already facing quite a few obstacles because they have very different business models. So definitely one to keep an eye on as well.
Chloe, thank you. Equities reporter Chloe Melly here at Bloomberg. Guy, we've got European stocks then on the back foot. London could outperform a little. I mean, iron ore prices up by 1.4%. Copper was higher. Oil prices also higher.
So you're going to see BP, Shell potentially moving, some of the big miners moving around all of this. Is that going to be enough to stabilise the London story going into this market open and through it? We will find out very, very shortly. It's actually quite a busy week in terms of the defence stock names as well. We're going to keep an eye on those at the open, plus Airbus. Anyway, the market open is almost upon us. We'll deal with the details in a moment. Wait for that. This is Bloomberg. Monday morning, good morning. There's a smorgasbord of factors at play today when it comes to these markets. What are we watching? What is doing the damage when it comes to futures? I don't know. Could it be this? Bitcoin. This is Bitcoin over the last month. We're down by 22%. The critical thing is over here. We're rolling back over again, and Monday morning is seeing quite a decent drop. So we're back down to the kind of the recent trough. So it's going to be really interesting to see whether or not we break lower from here. That could be one of the factors you want to be watching. What's happening in Japan? What's happening with commodities? All of these things at play this morning. The commodity story on the inflation front, very interesting. This is what European futures look like. Let me just kind of show you what the picture is. I haven't shown you what US session on Friday looked like, because remember, it was a shortened session and, to be honest, nobody was there. Eurostoxx futures this morning down by 0.3%. The FTSE's outperforming. Oil's going to do well today. You're going to see some of the miners doing well today. The DAX is down quite hard. Look out for Rheinmetall. Look out for Puma. Airbus this morning could be a factor as well on the downside after this weekend and the software update issues. So we are seeing a negative session. But what is interesting is we're also seeing a very negative session stateside. It looks like tech is under pressure going into this Monday morning session as everybody comes back from Thanksgiving and all the shopping they have been doing. The Nasdaq futures are down kind of 7, 8, 9/10%. That's the kind of story we're looking at this morning, Anne.
Yeah, absolutely. Nasdaq futures are weaker. Will the European tech session have something different to say? And I say that because we've got an interesting piece out from one of the brokers on ASML. This is JP Morgan talking about ASML, saying that the ASML and other long lead time suppliers may see strong orders in the fourth quarter of 2025. So a positive take there. And then we roll in the Airbus news that weighed on the ADRs, of course, in the States. But a lot has been rectified over the weekend. That Airbus A320 story that we've talked a lot about, the impact on airlines in focus, but also interesting research from JP Morgan on airlines, Guy.
OK, here we go. Monday morning session. Why are we seeing risk off? I don't know. There's a whole multitude of factors in the mix, but how is it going to represent in Europe? Let's find out. The FTSE 100, as you've already indicated, is expected to do better than most here. The reason for that is that you've got copper up, you've got iron ore up, you've got oil up. Commodities are moving higher. Now, take that to the next logical step, which is that an inflationary impulse that we need to watch out for, which is an interesting story when it comes to what central banks are going to do. The central bank story is represented as well. What's happening with the Fed, the Bank of Japan, what's happening in Australia. Stock 600 is down by 0.3%. The CAC is down by nearly 0.6%. The IBEX has been the big outperformer this year, is down over 0.3%. So it's going to be interesting to see what the story is when it comes to the CAC. Is that Airbus? What's happening with Airbus? It's a big heavyweight stock in that market. We'll wait for the DAX to get going. We'll wait for the Swiss to get going as well. We'll talk about those markets in just a moment. But maybe actually the CAC isn't down as much as we thought, and maybe the FTSE is down a little more than we thought. We're down by 0.3%, but maybe I'm picking here in terms of what the details we're seeing coming through on the market. So let's break it down. Stocks and sectors. Anna, what are we watching?
Yes, let's have a deeper dive then into some of these metrics this morning, shall we? The first point to make is, from a sector perspective, only one sector is going higher, and it doesn't even appear on that board you've got in front of you there. But personal consumer discretionary grocery stores, that sector is going higher. So Reckitt Benckiser, Greggs, actually, which is interesting. There's a lot of chatter in the weekend press around Greggs and the potential for corporate activity there. So those are going higher. That is the only sector, though. And to the downside, the worst performer is industrial goods and services. Delving into the detail there, it does look to be a little bit of weakness in defence once again. So Rent Group down by 3.5%. Thales down by 2.6%. Saab, Leonardo, Babcock, BAE, Airbus, all a little bit weaker. Airbus, with other news flow in mind, also down by 1.6%. Interesting that Basic Resources perhaps is not doing better on the back of expectations around stimulus in China. That was something that lifted Chinese stocks, but doesn't seem to be lifting the Basic Resources story this morning. And we did see higher copper prices overnight. ArcelorMittal is higher, so some of those mining stocks or metals names are a little bit higher, but it's not as standout as you might have thought it could be.
It's a down market, and you've got... So Reckitt's the best performing on the FTSE 100 this morning, so the defensive nature of that end of the market coming to the fore this morning. So people are looking maybe somewhere to hide. Unilever's also up, Diageo's also up, Imperial Brands is also up. But Shell is the second biggest points gainer on the FTSE 100. It's not up by much in percentage terms, but it is in points. Glencore's also tracking a little bit higher. Endeavour Mining, Fresnillo, also higher. So you look at the kind of the top 10 on the FTSE 100. It is the defensive names and a few grocers in there. Tesco is actually rising. On the downside of the FTSE, it's Rolls, BAE, that are leading the losses in points terms. So defence sector down, defensives are up.
Yes, there we go. The two uses of the defence word this morning, very important. Let us get a market perspective then, as we are in the last month of the year, 1st of December now. Dan Kemp joins us, Chief Research and Investment Officer over at Morningstar. Dan, nice to have you with us. So I guess it's not too early now to talk about preparing for 2026. It's not very far away, is it? And we've got just 1 month ahead of us. So how are you thinking about 2026 when you look at the way that we started trading in December? A little bit nervous, it seems.
Well, exactly. And as you say, it's the end of the year. There are fewer people around. There's tons of stories going on, and everyone loves a Christmas story. And the danger is that at this time of year, we become very focused on the short term. So as we look ahead into 26, then what do we see? Well, we see that prices are pretty high. We see that the opportunities aren't at the top level of the market anymore because of some of the concentration issues we've seen. Really, it's all about digging more deeply and not making predictions. The danger at this time of year is there are so many predictions, and of course predictions are the mother of surprise. The more predictions we make, the more surprised we are. The more surprised we are, the more mistakes we make. And so as we go into 2026, we have to be prepared for a wide range of possible outcomes.
OK, so we're prepared for a wide range of possible outcomes, many of which might feature AI, I suppose. So let's delve into that one a little bit. I mean, we've seen the Mag 7 clearly have benefited, but then there's a bit of oscillation around the Mag 7 and which exactly are going to be benefiting. NVIDIA maybe struggling a little bit of late, but still that theme lives on very strongly in the United States and broadens out into Europe as well and takes in the energy sector and construction and everything else. So what will the AI theme look like in 2026, do you think?
Well, that's right. Not only the US, so we're used to that concentration in the Magnificent Seven, we're used to the growth of NVIDIA, but then as you expand out even into the emerging markets, so you look at TSMC, it's 9% of the emerging market index. So we're seeing this concentration everywhere around the world. And what does that mean for an investor? Well, you have to be careful that you haven't got too much exposure, or that where you're looking for diversification, you're not just buying into the theme elsewhere. And so outside the Magnificent Seven, we're seeing good value in smaller companies, which are not so driven by the AI story. We're seeing differentiation, as you say, within the Magnificent Seven. Some stocks look better prepared for what's ahead in 26 than others. Some look better value. But overall, overall, it's looking away from those areas. Some of the areas you mentioned this morning in the UK, some defensives there, looking really attractive. And that's where investors need to be trying to balance their portfolios as we head into the new year. How important is it that the Fed cuts rates next year for equities to keep going higher? Well, that's what seems to be priced in, Guy, as you know. So we're pricing in 75 to 100 basis points of rate cuts next year as a market. That leaves a lot of room for disappointment. When you're expecting rates cut next week and next year, if that's already in the price, then there's potentially a lot of downside. So I would say for investors, don't anchor on just that good news upside. It's likely to be challenged over the next few months. But that's what keeping this, the lesson from November was that the relationship between stocks and the Fed is very, very high at the moment. So you're suggesting maybe that we don't get 75 or 100. If we get 50 next year, do equity markets go higher? What I'm saying is don't rely on it, and so you have to work out what's in the price, and therefore what are the other possible outcomes. And a lower rate cut mean that prices are going to be challenged, but you can still see some value. Do you think that the small caps, the industrials, are going to be enough to get stocks higher next year if the Fed doesn't deliver and everything's in the price with AI? Is it going to be enough? Is it a zero-sum game? Or if the Fed doesn't deliver and AI doesn't deliver or doesn't kind of match his expectations, do markets go down on that? Well, here's the really interesting thing. As you say, when you think about markets, we're used now to focusing on the largest market cap names because they've been driving everything. Whereas what we're seeing is value further down. So you could have a situation next year where overall indexes don't do so well if some of those things disappoint, but actually investors have opportunities for gains further down the market cap scale, outside the most fashionable areas in other parts of the world. Is that what happens, though? Like, in my experience, that's not what happens. When you see the big caps selling off and you see markets tumbling, if you were to see that, everything goes down. So are you talking about a relative trade or an absolute trade? If the big caps go down, do the small caps just go down less, or do they actually go up? Well, again, a really interesting point, Guy. And we've been conditioned over the last few years to focus on those large caps. They fall, everything else falls. If you go back to another similar market, the Nifty 50 market, I appreciate it's going back a long way, but there wasn't one catalyst that drove all of those Nifty 50 stocks to be taken out into the woodshed and shot. It was one at a time. Things went wrong, valuations collapsed, and people found value elsewhere. So you could have a much more interesting market in 26, where stocks that have been left behind, markets have been left behind, do better.
Right. And Dan, thinking about other themes then, as we look ahead to next year, we've talked a bit on this programme already about the dollar and the extent of the dollar decline we saw this year, which was actually quite material in terms of which stock markets then delivered and which currency you're in has a bearing on what your conclusions are about what did well in 2025. So do you expect dollar weakness to continue to be a theme in 2026, or actually have we run that one already?
Yeah, well, I think there's more room left to go in the dollar because it's still overvalued. So, of course, what we saw, as you say, and in particular in April, when people started generating these narratives around a change in the global world order, a change in the position of the dollar, a change in the US in the overall trading system, and that seemed to be the catalyst that drove the dollar lower. Well, a lot of those things look a little bit fanciful and a little bit early. But although the dollar's come down a long way and that has impacted the way people are thinking about returns, actually the dollar still looks expensive against most currencies. And so when you have that downward trend from an expensive asset, then that's where you could well see further weakness in the year ahead.
So it looks expensive, so it could still be a theme. Dollar weakness could still be a theme in 2026.
Right. Yeah, people need to be careful not to rely on the dollar in 26.
Don't want to put money in the US if the dollar's going down.
Well, you can put it in and hedge it. But
I need to hedge it, yeah.
But if you're putting money in and hedging it, then you have to be aware of that interest rate differential. So where you're coming from makes a big difference.
So you think Europe is going to be better? Is AI going to be more important in my portfolio, or is the dollar going to be more important for my portfolio? The S&P is up by 4% this year in euro terms. European markets have done much better. Europe has no AI, virtually no AI.
Yeah. Well, I would say that's the glory of diversification, Guy, that you can have that exposure to the US large tech stocks, but don't have it as the focus of your portfolio at a point where there's a lot of good news baked in, where when we look in other parts of the world, as you say, continental Europe, the UK, some of the emerging markets as well, we're seeing good value there, good opportunities for investors.
It's great to see you, Dan. Thanks for stopping by to see us. We really appreciate it. Dan Kemp, Chief Research and Investment Officer, joining us from Morningstar. Quick look at the Core 6 to figure out what is happening. This is the kind of centre of gravity here in Europe, and what we are watching is a market that's diverging a little bit. I have to say, some of the grocers are having a good day today. We're definitely more defensively biased, though I do notice that Nestle is a little softer this morning. Novo Nordisk is down as well. Luxury stocks are holding their ground. Defence stocks are weaker. Chips are up, which is fascinating. So that note from JP Morgan maybe is having... Was it JP Morgan?
Yes, it was JP Morgan. Yes.
It's having a big impact maybe on ASML. Yeah. But we start this morning, as we should most Monday mornings, but maybe with a bacon sandwich. Over to you.
Or a mince pie.
Yes, or a sausage roll. So Greggs is up this morning after an activist investor called the management timid and asked them to cut millions of pounds in cost unless they want to be taken over. So the activist investor has urged the company to cut those costs if they don't want to be bought, and therefore we are up this morning at 2.7% for Greggs. Moving on to Airbus, which is seeing a little bit of weakness this morning after the disruption over the weekend with the software update on the A320 aircraft requiring an urgent fix. It's something that was fixed fairly quickly, limiting the disruption, but some experts are saying that this means this software update was not rolled out with maybe the appropriate safeguards, and therefore we are down 2.5% for Airbus this morning. We are also down across defence as well this morning after US and Ukrainian negotiators said that they had productive discussions about a potential peace deal, and there's not been any final breakthrough yet, but the news of that progress on that front is really weighing down on those shares this morning. We've got Rheinmetall down 2.7% in particular. And finally, EasyJet is also seeing a little bit of weakness after being downgraded by JP Morgan because of weaker pricing and higher costs. On the flip side, Lufthansa was upgraded to a neutral rating because of the dynamics in the long-haul division being a bit more favourable. And so we have two different stories in that airline space this morning.
OK, Chloe, thank you very much. Yeah, those JP Morgan notes on the aviation sector and on the tech sector having a bit of an impact this morning, so we'll certainly keep an eye on that. And with aviation in mind, coming up on the programme, more than 6,000 Airbus A320 jets have required a software fix after some planes were grounded over the weekend. Most of that fix is now done. What's the lingering impact? What happens next? More on this coming up. This is Bloomberg.
Welcome back. You're watching the opening trade. The opening trade is behind us. This is what we're looking at in terms of the numbers. We are trading and we are down. As you can see here in Europe, the FTSE 100 is outperforming a little bit, but sentiment around the world is quite negative. Japanese stocks hit hard overnight. We're into Europe. We're being hit hard. Bitcoin's down pretty sharply. US futures are down pretty sharply. In terms of what we're seeing in the mix here in Europe, aviation's quite a strong theme this morning, which I always welcome on a Monday morning. It was quite the weekend for, I have to say, the Bloomberg aviation team, aerospace team. There was a lot going on, and most of it centred around this stock, Airbus, down by 2.15 this morning. This after we got the announcement relating to the need for a software update, in some cases a hardware update, but mostly a software update relating to the A320 family. There are a lot of A320s out there. I think that probably is one of the takeaways of this weekend. Anyway, the European aircraft manufacturer says, quote, the vast majority of its roughly 6,000 320s, remember it's 19s, 20s, 21s, 21 LRs, XLRs, all out there, have been modified. Bloomberg's managing editor for space and aviation, Benedict Campbell, joining us now with more. Betty, let's start off with, we know there was a fault and there was a need for a fix. How easy was it for airlines to get this done? And do we have a problem this Monday morning?
Well, it does seem like it went fairly smoothly and easily. So this announcement came out late on Friday evening, and it really caught everybody off guard, myself included. And Airbus saying about 6,000 aircraft, as you said, that's out of more than 11,000, would require this software update. Essentially not an update, but a revision to the previous version. What they found was that the current version being used there could be some interference with the flight controls under the condition of intense solar radiation. So rather a strange sort of confluence of occurrences, but that was it. And then over the weekend, the airlines really raced to get that software fix in. And we heard from everyone from New Zealand to India to Latin America doing this and doing it swiftly, so it seems, because this morning we got an update from Airbus saying that, as you said, the very vast majority of these planes are now fixed, fewer than 100 still requiring an update. You know, investors looking at this seem a little bit troubled, but not massively spooked. The stock is down a little bit, but it really feels like overall the company and airlines and travellers, as an extension, managed to dodge major catastrophe here.
Yeah, Benny, good morning. So we were wondering earlier on in the programme if this is the end of a story or if there's something else about cosmic radiation, solar radiation, that we need to wonder about, the impact it's having on software during flight.
I mean, software is susceptible to this, and the higher you fly or the higher you are, the more you are exposed to these small particles that whiz around the air, to simplify it somewhat. And obviously aircraft manufacturers try to sort of minimize that by having robust software, as much redundancy built into that software as they can. There was an occurrence a month ago with a JetBlue aircraft where there was sort of a freak input from the computer without the pilot really taking any action. And that was really the sort of patient zero that led to what we heard over the weekend. If anything, it gives you a sense of just how complex software is on an aircraft today, but also just how seriously the industry takes this whenever there is a scare, rather, you know, ground thousands of aircraft than sort of risk flying and then having something catastrophic happen.
I spoke a moment ago. 6,000 out of a fleet of 11,000, not just a fleet of 6,000. This is a huge number of aircraft, Benny, that are being affected by this. This is a huge fleet that is affected by this. Yet Airbus seems to, as you say, manage this reasonably quickly. Therefore, my next question is, does this impact what is going on at Airbus in Toulouse, in Hamburg, and all the other kind of final assembly lines that they have? Are we going to be able to hit targets by year end? Obviously, there's usually a race to hit targets by year end. What do we know about how this impacts kind of day-to-day operations at Airbus?
I mean, it's too soon to say at this point. I would have said, if this had dragged out into the week and the month, probably the answer would be yes, this will have an impact on their targets. This is a crucial month for Airbus, and they always manage to miraculously build huge amounts of planes in the last couple of weeks, and they have some ways to go. The target is for 820 planes to be delivered throughout the year, and as I said, they have some ways to go, but they think they can make it. Now, if engineers, if management had suddenly found themselves dealing with this sort of cosmic interference, that would have changed the game. But given that they've come out of this fairly swiftly, or actually very swiftly, and have managed to really sidestep the issue, I would bet that this is sort of a ghost in the machine, as you want, and really that it's over by and large, and that they are now able to focus on the day-to-day operations again, which in no small part is that target that they have for the end of the year.
Benny, thanks very much. Bloomberg's Benedict Camel joining us there from Berlin with aviation in mind and the Airbus story in particular. Now, that was a busy topic of conversation and busy for the Bloomberg team over the weekend. Black Friday in retail was also a busy theme. According to both Adobe and MasterCard data, sales on Black Friday rose from a year earlier, a sign that consumers are continuing to spend despite persistent economic concerns. Joining us now for more, Bloomberg opinion columnist Andrea Felsted, who has been focused on Black Friday and Cyber Monday, but also much else beyond. Andrea, good morning. So what can we take away from the shopping bonanza that has been Black Friday and today's, you know, happy Cyber Monday to you?
Well, we're only getting the early indications. It does look like they're up from everybody. Now, I think the interesting thing will be what people bought. What we saw with Prime Day is that consumers used the discounting bonanza to stock up on the things they needed. This is a bit different. Obviously, it's coming into the holiday gifting period. But even so, it will be interesting to see whether people treated themselves or they use this to buy the things they need, but at cheaper prices.
So there's some quite cheap dog food out there, I'm just going to say that.
That falls into the... I assume that's in the things you need rather than the gifting category.
Could be both. AI was really interesting. So for the first time, I have to say, talking to people about this, people used AI. it seems like this is the first time I've actually seen people going, right, where's the cheapest deal? And using AI maybe to find it. Is that the difference this time round?
Exactly. It seems like they used AI search or even AI chatbots to try to find the best deals. And this is interesting for retailers because, you know, as long as time, they've been trying to appeal to people buying things. And now they have to appeal to agents buying things or choosing things. So that's going to create a big shift in how they market, how they get things to search.
Yeah, absolutely. I mean, and that's also really interesting from a macro perspective, isn't it, what it does to inflation? Because it was, you know, the advent of Amazon and all of the other large marketplaces online that was credited with driving down inflation as part of the Great Moderation, partly, one of the stories. Right, let's turn to things that are not, well, I don't know if they're falling in price, but they're certainly not cheap in price, Andrea. Let's turn to your new article out this morning, which is all about Gen Z putting Cartier on their shopping list instead of a Rolex. So talk to us about detail.
OK, so we've seen this move in the watch market. It's been led by Cartier, but it is much broader. So for the past at least 10 years, watches have been supersizing. They've been getting bigger, chunkier, 36 millimetres and upwards. And what we've seen is, particularly among younger people, they're looking for smaller, gold, often rectangular, which fits in with Cartier, on a leather strap with a vintage feel, smaller size for women, but also for men. So this is really upending the watch market as we've known it for like the past 10 years.
So Jaeger-LeCoultre, presumably?
Yeah, Jaeger-LeCoultre, I think, will be the next one. GQ said the Reverso could be the it watch of 25.
It's a very pretty watch.
And they've introduced a more basic model. I mean, a watch like this isn't basic, but a more, and it's around, if I remember rightly, around £5,000, which isn't bad for a very nice watch.
OK, so we're not all about the sports watch right now, Andrea.
So that's a big shift.
You can know too much, is my thinking.
No. This is good stuff. Yes.
Big fan.
It's going to be, as you say, is this just cyclical?
I think there's an element of cyclicality, definitely. You know, we've had this trend to sports watches. We've got this much more elegant vintage feel. There is definitely a cyclicality. The other really interesting thing to watch is this has been led by Gen Z. Gen Z are under pressure from inflation, competition for sort of entry-level professional jobs. In the US, student loan repayments. There's a lot of fears that they're already starting to pull back in things like eating out. Is this going to carry on? If it does, then Cartier is very exposed because it definitely is the it watch of the moment.
And if you can't buy a house, maybe buy a watch. Andrea, thank you very much. Andrea Felsted from Bloomberg Opinion. Let me just tell you about a couple of lines that dropped really interesting from Masayoshi Son over at SoftBank, saying he didn't want to sell a single NVIDIA share. They needed the money to invest more in AI. So it wasn't necessarily a vote against AI or against NVIDIA when we saw SoftBank selling their stock.
In a moment, we'll come back to defence stocks. We're going to come back to the Russia-Ukraine story. We'll do all that in just a moment. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes into today's session. And, Guy, we've got a picture of negativity across most of these markets. Although, is it recovering a little bit at the margin? I mean, the DAX is firmly in the red, down by 0.7%. A little bit of negativity around the defence space. That could be weighing on that particular market. The CAC 40 also down by 0.5%. But all morning, we've been discussing how we are seeing weakness in US futures, weakness in Bitcoin, a lot of movement in Japanese assets. There's quite a lot going on for the 1st of December. And not entirely clear what is driving the risk-off tone. Interesting to see, though, that we saw US futures paring those losses just a little bit around the time we got those Masayoshi Son lines around NVIDIA. So we'll see whether that has any legs and that develops further. But just off those lows on US futures, but Europe still firmly in the red, apart from the London market, Guy, where we're increasingly seeing some upside from basic resources. OK, let's talk about the details and figure out what is happening. Unsurprisingly, the mix is reasonably balanced in favour of those stocks that are moving lower. 439 versus 149 up this morning, so the mix kind of tells you something. The volume number is actually quite weak this morning, which also tells you something, which I think is quite interesting in terms of what we are seeing. How convinced are the markets
buy these moves? Are investors buy these moves? Is everybody playing? Is everybody out there? Are we playing with a full set of trading desks this morning? Let's talk about the leaders and the laggards. ASML, this is JP Morgan note that Anna flagged a little bit earlier on. It's clearly having an impact because actually Nasdaq futures have been lower, but ASML has been higher, up by 2.6% this morning. Elsewhere, it's a much more defensive bias in terms of the markets, in terms of the stocks that are being bid. Unilever is up by 0.4%. Reckitt's up by 1.81%. So you're seeing that defensive story, that staple story, having a much better day of things. On the downside, let's look at some laggards. Airbus is off a little bit, despite the fact that actually the software fix appears to be done relatively easily. It is a huge fleet out there. 11,000, Benedict Campbell tells us, of the A320 family. So any issue with that aircraft is going to have a big impact. And we're seeing that maybe reflected in the stock this morning, down by 2.4%. But it's not a huge move. Think about what happened with Boeing in terms of some of the issues that it's faced recently. Rheinmetall, defence stocks are definitely on the back foot this morning, down by 2.6%. And Essilor losing a key executive related to its push into smart glasses. That is having an impact on that stock. That stock down by 1.4%, Anna.
Let's talk about some of the other stories we are keeping an eye on this morning, Guy. And cryptocurrencies are falling sharply this morning as Bitcoin slid as much as 6% to below $86,000 in early trading. The crypto market is on shaky ground, it seems, after a weeks-long sell-off that began when some $19 billion in levered bets were wiped out in early October. Traders are bracing for further pain amid concerns over meager inflows into Bitcoin exchange-traded funds and the absence of dip buying. US President Donald Trump says he has decided on his pick for the next Fed chair, who he expects to deliver interest rate cuts. Sources have told Bloomberg that Trump's chief economic advisor, that's Kevin Hassett, is seen as the likely choice to succeed current Fed chief Jerome Powell. Trump has frequently hit out at Jerome Powell, of course, for not lowering interest rates. And on to the Bank of Japan, BOJ Governor UEDA sent the clearest hint yet that his board might increase interest rates soon, highlighting the possibility of a move at the BOJ's December meeting. And we just want to note that in the last hour, during our coverage of the BOJ, we incorrectly showed a graphic saying that UEDA sends hints at a chance of a December rate cut. That graphic should have said UEDA sends hint at a chance of December rate hike. So, of course, we regret that error. And so just wanted to put that record straight. Guy.
Yes, and there's a lot of talk about cuts at the moment. The Fed obviously firmly in focus on that story. We'll come back to that in just a moment. Let's talk about maybe why European defence stocks are a little lower this morning. US and Ukrainian negotiators said they have held productive talks on a potential peace framework, but have not achieved a breakthrough yet. The US Secretary of State, Marco Rubio, spoke with reporters after meeting with Ukraine's National Security and Defence Council Secretary. Take a listen to what he had to say.
It's not just about the terms that ends fighting. It's about also the terms that set up Ukraine for long-term prosperity. I thought we started laying the groundwork for that, most certainly in Geneva. I think we continued that work in our communications throughout the week. I think we built on that again today, but there's more work to be done. This is delicate, it's complicated, there are a lot of moving parts, and obviously there's another party involved here that'll have to be a part of the equation, and that'll continue later this week when Mr. Witkoff travels to Moscow.
OK, let's get an update on where we sit this Monday morning on this story. Bloomberg's chief Europe correspondent, Oliver Crook, joins us now from Brussels. So, Ollie, give us the latest. Where do things stand this Monday morning?
So after those talks that we had in Florida yesterday by the Ukrainian delegation and headed by Marco Rubio, Secretary of State, of course, Steve Witkoff, the ambassador to Russia, the special ambassador, also in those discussions, who is expected to head to Russia a little bit later this week. The fact of the matter is, after that 28-point plan, which we got in sort of full detail, these negotiations have gone underground, and there haven't been many leaks about where they are in terms of the living document. We understand that now, obviously, that transition from a 28-point plan to a 19-point plan, but we don't know how much progress has been made on some of the stickiest issues, whether it's territorial concessions, whether it's those security guarantees. These are things that are being talked about behind closed doors, and we don't really know how much progress has been made by the United States. Marco Rubio says that progress is being made, still a lot of work to be done. As we know, the Ukrainians need to be very constructive in any of the messaging that they have about the meetings with the United States, but we will have an indication potentially of how much progress has been made when we get a clear idea of when Witkoff goes to Russia. And in the interim, there are obviously going to be some important moments of diplomacy to today, Volodymyr Zelensky will be in Paris meeting with Emmanuel Macron. As we speak right now, European defense ministers are speaking in Brussels. On Wednesday, we have a NATO meeting. Marco Rubio will come over to Europe. I think that is a pretty key meeting to watch because, as we know, the Europeans have been sidelined in many of these discussions. It's going to be an opportunity for foreign ministers to speak with the United States and potentially get to a sort of unified voice. Because remember, that initial 28-point plan had a lot of rules, not just for how Ukrainians should operate after the war ends, but how the European defense architecture should look, and also sort of rules within NATO. These are important points that these NATO allies will need to get to the United States to try to get their voice heard within that framework. So those are the sort of key developments we're looking for going into the week. That being said, guys, something that I think is pretty interesting is that we expect the Kremlin, we expect Vladimir Putin to go to India for a visit on the 4th and the 5th of this month. Does that sound like something that the president of the Russian Federation would be doing if you're in crunch talks and are about to get a deal over the line?
So Europe really trying, Ollie, to maintain its seat at the table or cling on to that seat at the table in these conversations. And we've got a lot to look ahead to today and into this week. An EU defence ministers meeting in Brussels. Zelensky meets Macron in Paris early this week. I mean, what is the focus for these conversations now?
Yeah, I mean, I don't know, Anna, that they even do have a seat at the table. I think they're trying to gain that seat at the table for the very first time in these discussions. And frankly, if you look at the last sort of few days, you know, they're probably maybe further from a seat at the table than they were, you know, a week ago in terms of the constructive attitude that they've had towards Ukraine. For example, where was Viktor Orban this weekend? He was in Moscow. He was hanging out with Vladimir Putin. They were discussing sort of oil and gas security for Hungary. But again, that sends a very sort of poor signal from the European side. We've had some commentary from other European leaders about Orban's presence there. But of course, the other main issue, and this is something that, again, we've been talking about for really months and months on end, is about the Russian assets and that reparations loan that the Europeans want to put up. Over the last few days, we've heard once again from the Belgians, and this really stands or falls by whether or not the Belgians are willing to move on these assets, saying that basically this may not be the moment. We have not really been fully reassured in terms of what can be done with these Russian assets. And frankly, at this stage, it might actually harm the peace process. So in terms of tangible, palpable things that the Europeans can do to advance the conversation, in the last few days, you have not seen any evidence of that. And for the Ukrainian defense minister, who is in Brussels today, or who will be at least attending those meetings, potentially virtually, maybe the only thing he's going to get from the Europeans is what he's got a lot of so far, which are reassuring words.
Ollie, thanks very much. Our chief Europe correspondent, Oliver Crook, joining us now from Brussels for more on the European defence story. Don't miss our exclusive interviews with the CEOs of Hensoldt and Rheinmetall, those taking place in the coming weeks. So there's plenty more conversations here on Bloomberg TV around the defence sector. Let's continue to focus on that sector. This morning, we're seeing quite a lot of weakness coming through in some of the defence names. As you see there, despite some deals being announced by the likes of Saab, we've got weakness coming through in Rheinmetall, Hensoldt, Renk and BAE Systems. Joining us now, Simon Hussain, Defence and Aerospace Equity Analyst at Alpha Value. Simon, nice to have you with us. So today, this Monday, we're seeing reflected in some of the pricing of these defence stocks, progress perhaps being made over the weekend, or at least these talks have not fallen apart. What is the working assumption for those in the defence community about whether this plan that originated with the US and Russia, whether it turns into a deal for peace? Is that the assumption that you're now making?
So I feel like the markets are trying to price in the peace uncertainty. So we are heading more and more towards a peace framework agreement that would be closer to the Russian side than the Ukrainian side. So our assumption is that at Alpha Value is that the peace might not actually be guaranteed, as the current peace framework is reportedly more favorable to Russia than to Ukraine, and I think it's something that might be unacceptable for European countries politically, as this peace framework between US and Russia would involve territorial concession, limits on Ukraine's military, as well as potential sanction relief for Russia.
OK, so not acceptable to many in Europe, Simon, not acceptable to Ukraine, perhaps, and that's why these conversations have been ongoing, of course. What say does Europe have here? What seat at the table can Europe expect to have?
So that's a very tough question, actually. It seems like Europe is really behind in terms of the talks. Everything that is happening now is between Washington and Moscow. So Europe really has to put some pressure to make sure it has a seat at the peace table. And I think it's crucial for Europe to have a say in these meetings. So this is the reason why we have seen so much meetings. President Zelensky is meeting with President Macron today. We have this Brussels meeting. So we see that Europe is really trying to have a seat at the peace table.
So if there was a peace deal signed tomorrow, would that have any impact on European defence spending? There seems to be this expectation that there would be, judging by share prices. But would there be any impact at all?
I think that there might be impact, especially on war-ready name. By war-ready name, I mean those that supplies weapon and ammunition, because we feel like most of these names have re-rated because of the war in Ukraine. So that might undermine the long-term demand for weapon and ammunition, at least on paper. But the modernization story remains intact. So everything that is related to electronic warfare, cybersecurity, control and command, air defense will stay important. So I think we might, instead of see a complete decline in all the European defense stocks, we might see a rotation within the sector from weapon and ammunition suppliers to more electronic warfare names.
There is this story that's beginning to emerge, and I think Chris Bryant's written about it this morning on Bloomberg, talking about the fact that some defence names are making really big margins at the moment, and governments may start to become concerned about this, and there could be some sort of attempt at clawback to maybe reprice, particularly ammunition, and kind of some of the more commodity end of the market where there are significant shortages at the moment. Do you think that's a possibility, that governments might push back against the pricing and the amount of money that names like Rheinmetall have the potential to make over the next few years?
I really think that is a that this is a possibility. This is the reason why there's so much pressure on names like Rheinmetall. I think that government won't let public spending pay for this kind of high profit. So for Rheinmetall, for instance, we're talking about a 30% margin in weapon and ammunition, which is very huge. So I believe that this is a risk. Yes.
This is a risk. So we're expecting to see some kind of. So what does that mean in terms of the margins that we should expect this sector to make, Saima?
So I do not think that this will change the margin on electronic warfare, cyber security, command and control system, as I mentioned earlier. I think those are high value added projects. So it will be difficult to put a cap on profit for those kind of projects. But I do think that for weapon and ammunition, which are way more simple, we might see some downward pressure on margin. And the key question is also what happens after the ammunition cycle ends. So, of course, if the war in Ukraine ends, it means that we will have to replenish European country stockpile of weapon and ammunition. But what happens next? And this is a key question.
Okay. Yep, the race is certainly on to refill some of those bunkers. Simon, just a quick question before you go. You cover Airbus as well. What did you make of what has happened over the weekend? Does it change your outlook on Airbus? It looks like the software patch has largely been delivered to most customers fairly quickly for the 6,000 or so 320s that needed it. Does it change your outlook in any way on the company?
I don't think it's changed my outlook at all, because the company made a lot of rollback fixed really quickly. So the issue is almost over now. Most airlines have completed the rollback fix. I think it's actually more a buy the dip opportunity than a change in the equity story. We might still see some compensation arrangement between airlines and Airbus, but I don't think it will be material as the fix was really quick, actually.
Simon, thank you very much indeed. Simon Hussein joining us, Defence and Aerospace Equity Analyst, joining us from Alpha Value, not Alphaville, FT, Alpha Value, wrong company. OK, let's talk a little bit about what's happening in the metal space, which is having a material impact on what's happening with the London market this morning. Copper and silver prices are being watched very, very carefully. Supply shortages certainly a factor. It's interesting, Bitcoin's going down, but the metals aren't. We'll talk about all of that next. This is Bloomberg.
Welcome back to the opening trade, 8:49 here in London. So we've been trading for around 49 minutes on these European equity markets, and we're still negative. We've pared the losses a little bit, though. Certainly the London market has had moments in the green. It's back down in the red right now, as in particular basic resources are getting a lift. And that takes us nicely on to our next story. There are big moves in metals today. Copper has advanced to a record high on the London Metals Exchange on fears the global market is heading for a supply crunch. Bloomberg's Martin Ritchie from our metals and mining team joins us now. So let's talk about copper first off, shall we, Martin? Thank you so much for joining us. What is behind this copper crunch? We seem to have talked quite a few times this year about concerns around supply on the copper side. Is that still the dominant theme?
Yeah, that's right. We've not just been talking about copper supply this year, but for a number of years. And it looks like some of these concerns are starting to sort of come to a head in the market. I was at a big copper conference here in Shanghai last week, and a lot of talk, a lot of discussion about what's going to happen next year. Mine supply has taken a hit this year. There's not really enough to go around for all the big new smelters around the world. And at the same time, you've got this pool of metal into the US because there's still the expectation that President Trump will put tariffs on refined copper next year. And the idea there is that there will be not enough metal left for the rest of the world. So what we had last week was the head of our Mercuria, Kostas Bintas, who's a very well-known copper trader and a bullish copper trader, sort of coming out again and saying, you know, this is going to be a huge trade. Copper's going much higher next year. So that's the kind of cocktail of things that are pushing prices up to a record this week.
So supply is a factor for copper. Is it also a factor for silver?
Yeah, that's right. And again, this sort of has a sort of US tariff story or backdrop here. Back in October, there was a rush of silver into the US because of a big squeeze on the COMEX silver market. Again, that was related to sort of expectations of tariffs, but also sort of short supply in the rest of the world. And we're just going to see in the aftermath of that, there's not a lot of metal in warehouses in China. So you've seen some supplies come out of there. It's just a sort of very stretched global market outside of the US, and that makes it vulnerable to kind of price spikes, the likes of which we've seen in the past couple of days.
Martin, thanks for the update. Certainly one of the key areas of the market to watch this morning. Martin Ritchie joining us out of Shanghai and what's happening with the metals. Let's talk about what we are going to watch for the rest of the week. It's been a busy start to the week, so let's carry on with what we are going to be looking at. EU defence ministers are meeting in Brussels today. Apparently people are still spending. I'm told it's Cyber Monday. Isn't everything kind of cyber these days? Anyway, it's Monday, therefore it is Cyber Monday. The BOE publishing its results of its bank capital stress test. I think that's Tuesday. We've also got the critical number Tuesday, Euro area November CPI. Macron's in China for the full state visit Wednesday. NATO foreign ministers are also meeting. Claims data Thursday as well out of the United States. And we've also got Friday, the Russia-India summit. We've got delayed September US payroll and PCE inflation data as well. How many blanks are those data going to fill in? What kind of a week are we set up for? It's been a bumpy start, so let's find out how we're feeling this Monday morning. Senior EMEA equity strategist Mike Masika joins us now. Morning, Michael. A bumpy start today. Kind of, is Santa coming? Is the rally going to sort of carry on, or are we going to get used to choppiness in December, which we don't normally see?
Well, that's true, Guy. You see, I think a lot of the consensus is very optimistic. Whether it's next year or whether it's December, there's a lot of optimism out there. The positioning globally has been trimmed like drastically during the volatility episode we just had, and so you know the buyback are restarting. The Fed is supposed to cut. So generally speaking, there's a very positive sentiment into December. So it's kind of surprising that we see some choppiness, but I think that's also because as everyone gets very positive, you know, the bar is higher.
Right, and it's not putting strategists off, the fact that the bar is higher. You've been writing this morning about RBC strategists. They see a 14% gain for the S&P 500 over the next 12 months. Is this kind of typical, Michael? Is this what we're starting to see in people's outlooks for 2026? Stocks higher?
Yes, that's exactly what we're seeing. Everyone is really bullish about next year. Everyone believes the Max 7 and all the AI capex is going to keep going. It's going to keep driving the market higher, keep driving EPS higher. Not just in the US, we're seeing that for all regions. It's double-digit EPS growth for every single region next year, much higher in emerging markets than the rest of the world, actually. But the US will still be among the leaders. Europe will have double digits. It's very positive. And you got to be thinking a lot of it has to go really right for it to happen. So that's a risk to the market.
Europe's outperformed this year, though. It's outperformed and it's had the euro or a weaker dollar.
Yeah.
Is that expected to carry on? Could Europe outperform again next year, and how currency dependent is that?
Well, it's very possible. The dollar isn't expected to rise much next year. Actually, like a lot of the forecasts are
down.
Yes. Why? Because the Fed is going to cut rates. That's the expectations, and so you know the monetary policy is going to converge like U.S. Europe. So there's no reason for the dollar to go up on that side. Now Europe can outperform if the drivers of the year, the drivers of this year, either keep going, or if we have a proper rotation into the laggards of last year, like all the large caps in Europe, the quality trade that's been lagging the market. This could take over from banks and defense, which are the two major thematics that have driven European performance this year.
Maybe they will be looking for ways to prove that AI is delivering productivity gains already, and that might be one way that they try, at least attempt to catch up. Thank you, Michael. Thank you for joining us. Michael Masika from Bloomberg, of course, with latest thoughts on stocks. European stocks then, Guy, on the back foot, but US futures pairing those losses.
A little bit. Anyway, it looks like it's going to be a bumpy start to the week. This is Bloomberg.